Hello, I'm Eric Mancini with Traphagen CPAs and Wealth Advisors. I'm the Director of Investment Research and a Wealth Advisor at the firm. Today we're going to do an overview of the second quarter of 2020 and delve into several different topics. We're going to look to year-to-date market performance and the different stages that we went through time. We're going to look at how different stock sectors performed. And there has been a large divergence this year between sectors such as utilities, technology, consumer staples, things like that. We'll get an update on, obviously, what's controlling a lot of this is COVID-19. So we'll get an update on that and trends we're seeing there. And then another huge impact on the markets has been the government stimulus, the CARES Act, which was passed back in March. And then as we speak, another round two, or actually round four, is being negotiated now. And most likely over the next couple weeks, another round will be passing, which will add even more liquidity and more support to the market. And then we'll do an overview of all the trades. Been a very active year in trades for us. So we made a tranche of trades in March and April, and those were mostly offensive trades. We made a set in May and June, which were some tactical, a little bit defensive, a couple defensive trades there. And then more recently, we did our summer rebalance where we got every asset class back to the targets we want, and a couple other one-off tactical trades as well. And then lastly, we're going to look at the election and a couple changes we made there. So first, this is a chart year-to-date 2020 from January 1st through the end of July. The red line is the global stock market. And what you'll notice is in the very beginning of the year, January through mid-late February, really the markets were ignoring COVID. Really didn't think it was a big deal. So we actually hit the all-time high, which was 33.91 on the S&P 500 right here in mid-February. Then when it became obvious that COVID was going to be a much bigger problem, when professional sports started to shut down, things like that, in this area, starting mid-February through early March, we had a measured, high volatility, but still measured type of just a revaluation decrease in the markets. And then finally, once we got to mid-March through the first day or two of April, there was absolute panic. So there was forced selling, there was market dislocations, and this is when the biggest opportunities arose. We had the overall stock market down 35% in roughly a month, which that was the swiftest crash, essentially, that we've seen since the Great Depression. And there was a lot of things to do in that period, and that's when we did make a lot of trades right in here. Then once the government came out and the Fed, in conjunction with Congress, they passed the CARES Act, which bolstered unemployment, stimulus checks at $1,200 to many individuals, and also the PPP loans for small and mid-sized businesses. And in addition to help some large businesses such as airlines, and in addition to the Fed coming in, reducing interest rates, purchasing all types of assets on the open market, that really juiced the markets, ended the crash, ended the dislocations in many of the markets, and that's when we began the increase in markets. And this was still pretty high volatility in here, April, most of May. Low confidence. A lot of investors did not believe the rally. They just could not understand why the market was going up. So it was low confidence, high volatility. And then finally, starting maybe in June, we started to see some better actually economic numbers, some job numbers than we originally thought we were going to see in terms of unemployment. That's when volatility came in further. So it was a lower volatility increase. And some investors got more confident in the sense that, okay, the worst is probably behind us at this point. And as we speak now, we're not quite there, but almost back to all-time highs on the S&P 500. I think we're within about 1.5% or 2% of an all-time high, and we are up on the year, actually. So it's been a half year or 7 months for the record books, and one we're not soon to forget. But the moral of the story here even though February, March, early April were extremely scary. Some of the scariest, many people have seen in terms of volatility, dislocation, and just general sense of, the pandemic. Um, if you just held through, you wouldn't have noticed. That's really the game plan here of the markets and your long-term plans is just to hold through and try. I know it's hard, but try to ignore short-term panics. And then within the stock market, if we really dissect it, you'll see many different sectors. So, and very different performance between them. So, tech and healthcare arguably either were not really affected much, or especially in the case of technology, many technology companies actually benefited from the pandemic by people fast forwarding their use of e-commerce. Obviously, healthcare is sort of self-explanatory. We're all using Zoom and doing webcasts and webinars, and all kind of tech is just being fast forwarded. So you'll see here, technology up about 20% on the year, healthcare maybe up 6 or 7% on the year. So these have been either not affected or positively affected by the pandemic. And tech and healthcare are the biggest components of the S&P 500. So that is one of the reasons why the S&P has done well, despite the pandemic and recession. Then we have a bunch of sectors that have been affected to some extent or basically neutral. So these would be consumer staples, groceries. So basically they've been unaffected. In the beginning, they actually got a bump. Now that bump sort of stabilizing out. Utilities, industrials, materials, maybe slight negative effect on those. So these sectors are anywhere from break even on the year to down about 10%. And then you have the worst performers, and these are the most economically sensitive sectors. These would be energy, financials, and real estate. And, some of this is obvious. Real estate, without, a lot of people, going to offices, a lot of people are questioning office real estate in many big cities, especially. So that might take a hit. Rental payments have certainly gone down as a percentage of total, 2019 payments. And, in addition to commercial, you also have to look at the other sectors of real estate that were hurt by this. Not so much residential, although rents, a little stress there, but obvious, retail. So a lot of retail space, especially that house small, strip malls, small retail in the city, things like that have just been really, really hurt. And, it could be quite a long time before certain parts of real estate recover. Financials loan to small businesses. So they were significantly hurt. And energy is the actual worst sector. And that's just because of the strong, pullback in demand that we've seen. So it's important to really not look at the stock market overall, although, that's certainly one thing to look at, but you really have to go sector by sector and say which ones do we want to really be exposed to. And fortunately for all our clients, they are overweight tech and healthcare with a small overweight to utilities, but really tech and healthcare where we've weathered this storm well. So moving on to COVID and trends we're seeing. So, I'm not going to go through all the numbers here, but long story short, we went through the first wave in March and April, of course, and then we had a steady and pretty swift decline through most of May and early June, maybe even mid-June. Then we saw a second wave. And fortunately, that second wave has crested, at least for now, and we're coming back down now the other side of the second wave, which is not yet depicted on this chart, but the chart's a little outdated at this point. But we are coming down the slope, the good side of the slope on the second wave. So total U.S. cases, especially now in the South and the West, are coming down pretty significantly, which is good. Northeast, pretty stable at a pretty low levels. We're seeing some increases in the Midwest and the upper Midwest, a couple Northwestern states, but overall now the second wave has seemed to have crested and now coming down. But even more importantly, we're learning how to treat the virus better. So even though at one point during the second wave we had more cases than the first, the deaths were far under the original wave. And that's that brown line you see in the chart, the deaths as a share of hospitalizations. During the first wave, 3, 4, 5%. The second wave, really 1, 2, 2.5%. So we're just learning to treat the disease better. And of course, we're all looking for positive headlines in terms of a vaccine or further treatments, and that would obviously further improve these numbers. And then again, just as another look here, the top graph is the total number of cases in the U.S. And you'll see wave 1, of course, here, where you had the strong increase in cases. Then it sort of plateaued, and then you'll see wave 2 again on the uptick here. This is a little outdated again, so if I were to run this out, it'd probably be trending down at this point. And then if you look at a logarithmic scale, which a lot of people look at it for virus spread, obviously wave 1, strong logarithmic growth March and April, flattened out. And then on a logarithmic graph, you just see a little bit of wave 2 in here, inflection back up. But again, that is flattened out again too. So even though this is going to be choppy, even though, as we reopen, we might see certain areas of the country, increase the amount of cases, decrease, certain states come in and out, it's looking overall that we've, gone through this second wave with a lower percentage death versus hospitalizations and total cases, which is good. We're learning to treat better. And even the number of cases seems to be coming down, which is also good. And then just picking 2 recent hotspots, Arizona and Texas. You see here, really starting in June, strong impetus up. And they really never even had a first wave. It was just all building to this initial one. And then if I continued out, we're probably closer to 1,000 at this point. So Arizona's come down pretty significantly. Texas peaked at this point when the graph was drawn. And now again, this is probably down pretty significantly in 6,000 a day or so. Still a lot, but we're certainly in the right direction on the recent hotspots, certainly improving. Now, moving on to another big and perhaps the biggest piece of the stock market recovery. It's been government intervention and stimulus throughout the year. So this is actually going back to 2008 to show you the difference in response. So in 2008, this is the graph of the Fed's balance sheet. So how many assets that the Fed is holding. Essentially, you could think of this as monetary stimulus, and this is measured in trillions. So the more the Fed buys, the more they have on their balance sheet. And this is the Fed buying mortgage-backed securities, treasuries, investment-grade bonds, municipal bonds, all types of assets to help spur the economy and support prices. So back in 08, well after the recession started in 08, it took them a long time. This is the first time they did this type of quantitative easing. They added $1 trillion in late 2008, early 2009 to help the recovery back at that point. What you'll see is in 2020, really within a couple weeks of the stresses starting, they just went all in and said, okay, back in 08, we added $1 trillion. We're going to go, you can measure this in different ways, but about 3.3 trillion added in early 2020, which is more than three times what we did back in 08 and 09. And that's why we've seen such a comeback, or one of the reasons we saw such a comeback in the markets, is just the immense amount of support the government is putting in. And the Fed really, they just came out last week and said, they have no plans to lower their balance sheet. Chances are they will keep increasing the size, and that would keep supporting financial assets. And then these are some of the trades we've made. So these are the offensive trades made in March and April. This is when the panic was at its worst, prices were at their lowest. Not that we, of course, hit the exact bottom, but we're certainly, near in between mid-March, early April. We saw a lot of opportunities at that point. So these are examples of trades that we made. We added to large cap tech, high yield bonds, public real estate for the first time in years, utility companies, natural gas oil pipelines, and high yield tax-free bonds. And even some of these numbers are now, they're changing essentially every day. But for instance, IGM, now for most clients are probably closer to 45 to 50% up on that trade on large cap tech. And the rest should be pretty close. But all these offensive trades made back at the height of the panic, even though it was a tough time, that's when, the biggest opportunities arise and we can make the most money for you. And that's what we attempted to do. And all these were, risk on offensive trades, in the, when there was blood on the streets, as Warren Buffett says. Then as we came through, stock market started to recover. These trades were made in May, June, and you could think of these as more tactical trades. Some of them offensive, some of them tactical, some of them defensive. It's a mix. So we went higher quality investment grade to be a little safer, and that's the GIGB fund. That's a higher quality version of LQD. So they're all investment grade bonds. So that'd be bonds of like Johnson & Johnson and Microsoft, good companies, but even a little higher quality. So we're getting rid of some of the higher indebted companies within that fund. We put more into foreign developed growth stocks. So these are companies like Nestle, Roche, SAP, good quality, either technology, consumer stocks, things like that in Europe and Japan that still have good growth, but are more reasonably priced than US growth stocks after their run. SRVR, that is a public real estate fund that only really concentrates on cell phone towers, data centers, really real estate serving technology. And that's been a nice addition. ARKK, we're going to probably come out with its own webinar, a little more information on that. Very interesting technologies. We're investing within that fund. Genomics, artificial intelligence, crypto, robotics, autonomous transportation, things like that. And that has been a great performer for a lot of clients. And then we trimmed out some lower quality. That was one of our offensive trades. We sort of cycled out of that after that recovered so quickly. And this has been a mix of tactical trades made in May and June. And then recently with our rebalance, first of all, we made many trades, quote unquote, normal trades to get us back to where we want to be in terms of different assets, different percentages to US large cap stocks, different types of bonds, commodities. And then we also made a few other changes as well, where the FREL, which was just the broad public real estate ETF that we bought back in March and April, after a quick 15% increase, we sold that in a somewhat defensive manner and cycled that into INDS, which you see at the bottom. And that is Industrial Warehouse Real Estate Fund. And that is really exposure to e-commerce. The industrial, the warehouses, they support companies like Amazon, things like that, Walmart with e-commerce. Cheaper valuations there, strong growth, 2% yield. And actually now the updated figure on the performance on that is closer to 5 to 8% actually at this point with INTS. Emerging for our more aggressive clients, partial US election hedge and partial cheaper valuations for solid stocks. So we increased slightly XSOE. And then also for a partial election hedge. And again, an additional allocation to developed foreign growth stocks, more allocation to EFG. So these are some of the more recent or the most recent trades we made in July and the very beginning of August. And then lastly, look at the election. And, the markets really ignored this to this point, really concentrating, rightly so, on the pandemic. But in the future, later on this year, it will certainly become, I don't know when the market will pay attention to it, but it certainly will. And this is a website we look at that it uses people actually putting money on the election in terms of betting or investing, depending on how you look at it. But it does tend to be quite predictive. And it's had pretty good forecasting abilities in the past. So we do monitor this. And at this point, it's still anybody's race, of course, but it does seem to be leaning in the direction of Biden at this point. And, in addition to Biden, this leaning towards Biden in terms of the presidency, there's also a pretty good chance of the Democrats taking the Senate and the House. So our base case, although low confidence, but our base case is now, Biden taking the presidency and a possible Dem sweep of Congress. And if that were to happen, we want to take some defensive action, just because some of the policies, not saying they're right or wrong, but you just look at the impacts they would have. Where if we did get a Dem sweep, the likely outcomes would be higher corporate income tax rates, which would bring down corporate profits, of course. And by our internal research, we're figuring if the tax rate went from the current 21% to Biden's proposed 28%, all else being equal, that could be about a 10% hit to corporate earnings and to the S&P 500. But somewhat counterbalanced to that might be an increase in healthcare spending, expansion of Obamacare, and there probably would be a pretty big infrastructure plan passed in the 1 to 1.5 trillion range as well. So that could be a boost. So there's some offsetting factors, but we did take slight, just mainly because of the corporate income tax probable increase. If there were to be a Dem sweep, we did move some funds from U.S. stocks to foreign, where it would have no effect. Yeah, just wanted to say, thanks for tuning in. Of course, any questions you have on this presentation or any other questions you may have on any topic, feel free to email me. My email is at the bottom, Eric with a C at tfgllc.com. Thank you.